All right. Well, I want to thank everyone for joining us today for Investor Power Hour. We have a fantastic speaker that I'm very excited to hear about. She has a lot of insight, yeah, about taxes, and the discussion is going to be on what investors are missing about taxes in 2026. Deborah Pritchard is going to give the presentation, and any questions that anyone has, we will address at the conclusion. And I'm really looking forward to it, Deborah.
All right. Well, we are talking about my favorite topic, taxes. I stay awake at night, reading tax books because I just find it so interesting. Today's presentation really is about what are we missing in 2026 taxes? The presentation is really designed for investors at all different stages, new investors, high net worth clients. We're going to add emphasis on planning opportunities that become more important as your portfolios, your income, and your balance sheets grow more complex. Um, you know, Too often I found clients came to me after everything had been done, and most of the times we can't fix any of those things. Had they come before they even decided to buy an asset or sell a portfolio or sell real estate, we could have done a lot of planning. And that's what I'm hoping today that will give you something to go away with. Um, Nothing today is actually going to be tax, legal, or investment advice. The goal of today is just to help you ask better questions when you go see your tax preparer, your attorney, or your advisor before the taxable event actually happens. So the 2026 tax story is not that tax rates went up. It really is, we got a lot more clarity about 2026, but even though we got more clarity, it still didn't make anything simpler. The top ordinary tax bracket stayed at 37%. Estate and gift tax is 15 million per individual at the federal level. That's very high by historical standards. The net investment income tax still sits on top of investment income for higher income taxpayers, and retirement plan limits are higher. 24.5 for individuals. There's a catch up. This year, there's a super catch up. There's a high income earner Roth added where we can only actually catch up by putting the catch up into a Roth. Um, those are all things that we'll address a little bit later. But what I really want you to take away today is more than the numbers. I want you to take away the missed opportunities that you might have had. The missed opportunity is not usually just one deduction. It's the interaction between when you realize income, where you hold your assets, how you transfer wealth, whether you have charitable intent, how much liquidity you need, and what your future tax bracket might be. For high net worth investors, this can affect your estate design, liquidity events, private fund commitments, charitable planning. For newer investors, it affects things as basic as whether a taxable account is holding high turnover funds, whether Roth eligibility is used before income rises, and whether records are kept from day one. The, as a new investor, you are building the foundation to build your wealth, and the habits you form now will pay off in the long run. Uh, so the roadmap, this is kind of how we're going to go through the presentation today. We're going to establish the baseline. We're going to identify what investors miss. We're going to apply what we call traditional asset playbook, pressure test alternatives, and then we're going to leave hopefully with an agenda that you can take to your advisor, your tax advisor, your attorney, a wealth advisor, investment team. I can tell you that when I was at the CPA firm, I worked with all of those people, like when we were designing an estate, if we were looking at, how should we set, we're going to buy this asset, how should we, what type of an entity should it be in? What kind of income is it going to generate? Is it going to be passive income? Is it going to be ordinary income. So all of those things, I'm hoping that you can leave with something you can take to your advisors, your team. All right, so 2026 gave us, as I said, a lot more certainty, but it did not provide simplicity. The US tax code is hundreds of pages long and it is complex. Um, let's see. I want to say that taxes in the US are not driven by one deduction, they are driven by layer deductions. It's not one rule, it's layers of rule. We look at ordinary rates, capital gains rates, net investment income tax, state taxes, AMT, Medicare premium surcharges. As you get older, that becomes something you should be aware of. SALT limitations, which is the state and local income tax, deduction phase outs, retirement account rules, passive activity rules, and estate rules can all interact. And a good planner looks at that big picture and puts all of that stuff together. We look at how it affects all of those things so that we can minimize the taxes that we're going to end up paying. So often people would, they'd come to me like with their tax, to prepare their, let's say we're preparing the 25 tax returns, they bring me their stuff for 2025. Anything that they did, it's too late for me to fix. So when I talk to them and saying, okay, if you're going to do anything in 2026, let's talk about it now. Let's talk about it again in September. Let's talk about it in December before the year ends. Because if we want to be able to do anything, we have to do it before the filing season. Because once filing season comes, it's really too late. Okay, so we're going to talk about the eight misses first. First miss number one is confusing your tax bracket with your marginal tax cost. And what this really means is, I would have people come in and say, oh, well, I'm in the 20% tax bracket, or my ordinary bracket is 37%. But that's not always the real incremental cost of another dollar of income. That additional dollar of income may trigger net investment tax, state taxes. It could increase your Medicare charges, could put you into AMT. It could give you a reduction in deductions or a phase out of some benefit. The cost of the next dollar is sometimes higher than the headline printed on the tax table. There are 9 states that actually have no state personal income tax. Those states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. I've often done tax plans where somebody has been moving from, let's say, Texas to North Dakota or South Dakota, and we actually look at all of the state taxes you might be. And it's not just always state personal income tax. It could be, do they have like a state, like we pay state tax here on anything I buy in the state of Texas. So I'm paying 6.25% to the state. And then each little municipality can add on up to 2%. So we look at those rates as well when we're looking at, anybody that's wanting to actually move. But as I said, your tax bracket is very different from your marginal tax cost. So for new investors, the same principle applies at a much lower level, like knowing whether you are creating short-term or long-term gains, knowing which tax lots you might be selling, because as we buy, maybe I bought Apple 5 times in the last year. Each one of the times I bought it, that is a specific tax lot. So when I look at things, am I selling first in, first out? Am I selling last in, first out? Am I selling part of this tax lot and part of that tax lot? Knowing the difference between qualified dividends and ordinary income. These are habits that new investors are forming now. Qualified dividends get a preferred tax rate. Ordinary dividends, they are taxed at your ordinary tax rate. So it can make a big difference. If we remember that, um, long-term gains, we pay 0% up to about 49,500. So knowing whether you're creating qualified or ordinary makes a big difference. Um, let's move on. Okay, so miss number 2 is treating all accounts as interchangeable. So the same investment can produce a different after-tax result depending on where it is held. Asset location is the idea that we can have different after-tax results depending on whether it sits in a taxable brokerage account, a pre-tax retirement account, or a Roth account. This has nothing to do with changing our risk tolerance, but it has everything to do with holding assets so that we reduce any unnecessary tax drag. Tax brokerage accounts can be a strong home for tax-efficient ETFs, for qualified dividends, long-term gains, and sometimes some municipal bonds. Pre-tax retirement accounts can be useful for ordinary income-producing assets and rebalancing. But they come with future distribution and estate considerations. So we think about that stuff. Roth accounts are powerful for high growth assets because they grow. The growth may ultimately be tax-free. But access and contribution limits require planning. So if I was a high net investor, account location should be part of my investment policy. For new investors, the takeaway should be you need to be intentional early. You need to use your tax advantaged accounts where appropriate, avoid high turnover assets in taxable accounts, and understand the trade-off between Roth and traditional contributions. Okay, we're going to miss number 3, ignoring invisible surcharges. And I don't think we often think of surcharges when we think of taxes, but things like the net investment tax, or when we talk about the Medicare IRMA, anybody that's on Medicare, what you pay for parts B and D is actually determined on your modified adjusted gross income from the prior 2 years. They do a look back. So I would have clients that would, elderly clients that, sold their home and perhaps made $1 million, and the first 500,000 actually was part of the exemption. The other 500,000 they paid tax on. Well, what that did is the following year, they said their Social Security went down, but what actually happened is their Medicare premiums went up, so it reduced the amount that they were getting every month. So it can change your cash flow from year to year by ignoring these different types of charges. So the net investment tax is a 3.8% tax that can apply to investment income once a modified adjusted gross income exceeds fixed thresholds. And the key word here is fixed because it is not indexed for inflation. So when we have income that is not indexed for inflation, over time, it brings more and more investors get pulled into the tax, even though they may not think of themselves as, a high net worth client. So this is another reason why timing matters. A Roth conversion, real estate sale, private fund distributions, exercising options, capital gain harvesting, or business exits may all be sensible, but the year it happens can change the total cost. So the goal is not to avoid income. The goal is to control the year in which the income lands. That's what we're trying to do. Miss number 4, assuming that the $15 million estate exemption means your estate planning is done. We need to broaden our estate planning beyond the federal exemption arithmetic. High net worth families still need to think about state estate taxes, basis catch-up trade-offs, control, creditor protection, divorce risk, beneficiary maturity, special needs planning, succession, family governance, The tax result is only one part of your entire estate plan. There's really a trade-off between removing assets from an estate and preserving basis step up. So, a transfer that looks attractive for estate tax purposes may not be optimal from an income tax standpoint if the asset has substantial embedded gain. That's why estate planning and income tax planning have to be integrated. For emerging investors, estate planning is not only about net worth, beneficiary designations, account titling, term life insurance, healthcare directives, and basic wills can prevent expensive and painful mistakes. So often I would get a client in and um, they would not have changed, they would have gotten a divorce and, they would not have changed the beneficiary of their IRA or their 401k. It would still be in the ex-wife's name as opposed to the new wife with who the person has had a family with. And the that is really hard to change if it can be changed at all after the fact, because the company is going to send the ex-wife the money. So, I mean, avoiding that by making sure that your beneficiary designations are always up to date is recommended. Hit Miss number 5. Itemized deductions are now more strategic than they have been for a while. The SALT limit, the state and local income tax, was raised to 40,000, but that isn't for everybody. There's still a phase out range there. Um, so, the phase outs, there's limits on deductions, means the benefit of a deduction can vary depending on income and timing. So in some years, like we want to bunch deductions, so that the charitable giving, to get over that 40,000, that is actually state and local taxes. So I live in Texas. I don't have any state tax here, but my real estate taxes also are considered local taxes. So prior, they have been capped at 10,000. Now I have up to 40,000 that I can deduct. Well, 40,000 is going to take me probably over the standard deduction. So if I can actually deduct 40,000 for my state and local taxes, I may look at, bunching, or any charitable giving that I give will also be part of my itemized deduction. But charitable giving is changing in 2026 as well. So it is another one of these things that requires planning. Um, you know, Sometimes we use donor advised funds. So I give 200,000 to um, a donor advised fund. I get a charitable deduction for that 200,000, but I can actually over several years decide who that money, what charity I'm going to give that money to. Um, so it itemized, as I said, but the itemized deductions are becoming much more strategic, and it is something that you'd really want to be talking to your investment team about. A young investor charitably buys a home. Maybe you have variable income in that year. You can benefit about thinking about the deduction timing rather than treating tax filing as a once a year cleanup. Um, if you talk to your tax preparer ahead of time and, tell them what you're thinking about doing, what charity, like what your state and local taxes might be. Do you have any mortgage interest that you can deduct? Um, it can benefit you by talking to your tax preparer first. Uh, Miss number 6, buying alternatives without reading the tax package. So alternatives can be all sorts of things, but this is where um, I have done a lot of my investing in real estate partnerships where we bought apartment buildings. Um, Part of your due diligence should always be that you should always be asking is, well, when are K1s delivered? Because if I get my K1 after April 15th, that means I have to file an extension. And maybe I've never filed an extension and I don't want to have to file an extension. So asking when K1s get delivered. Here at Disrupt, we get all of our K1s up because we prepare them in-house. We get them all out by March 15th. So it means if you're only investing with us, you wouldn't have to file an extension because you'd have your K1 in time to do your April 15th filing. But that is a question you should ask. Are there going to be, if you're using a self-directed IRA or a 401k, is there going to be UBITs if the investment, by holding the investment? And what will that UBIT be? And UBIT is usually only on the leveraged portion of the deal. So, I mean, if you put 100,000 in and let's say leverage that gets allocated to you is 400,000, you're only paying UBIT on the 400,000 because you're actually benefiting from that $400,000. Your IRA is benefiting or your 401k. So Congress decided that we should pay tax on that since it wasn't really our money that we were benefiting from. Well, you have state filing obligations. So, I live in Texas. If I invest in a partnership where they bought an apartment in Georgia or Florida, will I have to file state taxes in those states? The income that I'm going to get, is it going to be ordinary? Will it be capital gain? Will there be any interest, depreciation driven? Are there estimates of taxable income versus cash distributions? Investors should always be tracking basis, be aware of when they're doing their due diligence, like capital calls. How do capital calls get, how do those affect my investment? Distributions, suspended losses. Is this passive activity? What about at-risk limitations? These are all tax issues that you should discuss with your tax preparer because they can affect liquidity and decision making throughout the year. In some partnerships, you might be allocated income, but actually not given a distribution to pay any tax on that income that you've been allocated. It's something we refer to as phantom income because I'm going to end up paying tax on something I never received. So part of your due diligence is to maybe try and think about what the tax result is going to be because it can be very different from the economic gain. Often when they're telling you about an internal rate of return, let's say of 17%, that's a before tax internal rate of return. What's going to be your after tax internal rate of return? So alternatives are not just investment assets. These are what we call tax operating assets. All right, myth number 7. Discovering QSBS, which is qualified small business stock, too late. Qualified small business stock has many tax advantages, but it has very strict rules. And they actually loosened some of those rules in this last tax bill. So it's really important to understand, it has to be a C Corp. Like you need to know if the shares were they acquired at original issuance? Does it meet the gross asset test? Is the business a qualified business? How long have you held the shares? Because basically, qualified small business stock used to be if you held the shares for 5 years, you could, claim up to 10 million tax free. There's 10 million or some other gross income that you could actually claim as it would be tax free. So, I mean, it is a huge bonus if it is qualified small business stock. But as I said, it has very strict rules. If you're looking at investing in a C Corp, you should be looking to see what it is you're actually getting for your investment. And is it Section 1202? Okay. Myth number 8. This is understanding tax drag in traditional portfolios. And tax drag is what I would call the difference between what an investment earns on paper and what I actually get to keep after tax. Tax drag comes from things like high turnover funds, short-term trading, taxable bond interest, non-qualified dividends, mutual fund capital gain distributions, and poorly timed purchases before distributions. None of these might seem catastrophic in a single year, but over time, they reduce compounding. So the point is that that is not that taxes should drive every investment choice. The point is that after-tax return is what the investor keeps, and that's what should matter. We want to look materially, that before tax can look materially different than after tax. If one version produces unnecessary annual taxable income and another defers it or minimizes it. For high net worth investors, this is portfolio construction. For early investors, this is a habit issue. You favor tax efficient vehicles in taxable accounts, avoid excessive trading, and understand the tax character of return matters almost as much as the return itself. So taxes should not override investment quality, but after-tax return is the return that compounds. Okay, and compounding matters. All right, so that was our 8 misses, and those affect all of us. I can't honestly say that, every client I ever had missed one or two of those. Maybe they missed all of them. And by coming in, at least, we could try and make the next year better. So some of the things that we would talk about, so, impact moves that they could, when we sell stocks at a gain, we're looking at maybe harvesting losses to actually offset the gain so that I wouldn't end up paying any tax. And if I really like the stock, I could look at buying it back, but I would want to do things like avoiding the wash sale rules, because if I buy it within a 30-day time frame, I can't actually use that loss. It just reduces my basis. So we are looking at, harvesting losses, maybe buying the stock back, but it's a timing issue that we would be looking at. As I said, tracking when you buy stocks, tracking your specific lots makes a difference, because it can be the difference between, short-term or long-term gains. So it's important to track your specific lots. Coordinate your Roth strategy. The backdoor, the mega backdoor Roth strategies can help high income earners, but there's pro rata rules. If you've ever made a contribution to an IRA that we call that you weren't able to deduct, a non-deductible traditional, that affects your your Roth strategy, because the IRS takes pro rata. It's not so if you have an IRA and you just made a contribution, it's not going to take that last contribution. We have to take a pro rata of all your traditional IRAs. So having non-deductible non-deductible IRAs can affect our Roth strategy. As I said, qualified versus ordinary dividends makes a big difference. I had a lady, and her investment advisor did an awesome job at, putting her into high dividend earning investments, but they were all ordinary. They were not qualified. And so she ended up paying, at the highest tax rate. So when we, looked at it, she would have been probably better off in investing in other vehicles that would have given her qualified dividends, which get a preferred tax rate, same as a capital gains tax rate, rather than her ordinary rate. And we need to plan cash needs, because a lot of the partnerships I'm in, they're not liquid. I can't get any cash out of there except for whatever distributions I might be getting on a monthly, quarterly basis. So, if you need to sell for liquidity, you want to sell, we look at, like, what else is going to happen in this year? Can I actually defer that sale until next year? Do I need to sell it this year? So if I need to sell it this year, maybe I wouldn't do a Roth conversion. We would look at everything that we were going to be doing in that tax year to make sure that we were minimizing our taxes and tax drag. Retirement account playbook. Okay, so the 2026, the contribution ceilings matter. As I said, it's 24/5. They actually made a catch up, like from 60 to 63. You could actually put in another 11,250. There was a super catch. That's actually the super catch up. The general catch up is 50 plus. That's 8,000. The super catch up was between ages 60 and 63. And then for high income wage earners, if you're going to do a catch up, you're limited to putting it into a Roth. And by doing that, that's not going to be an immediate tax deduction for you, but it's also a way to get funds into a Roth when it's difficult to get them in there for high net worth, high income earning individuals. Um, we talk a little bit about, like, in planning, we talk about tax rate arbitrage. And arbitrage is really the strategy of paying tax at a lower rate instead of a higher rate by controlling when, where, and how income is recognized. So all of those things, as we said, makes a big difference, when, where, and how we recognize income. And you need to be planning for that. So, for new investors, the message is even simpler. We want you to automate the behavior. I used to tell my kids, once that money is coming out of your paycheck, you're never going to miss it. But if you don't start it right away, it's going to be harder later on when you've bought a house and you've got more expenses to actually take part of your paycheck and put it away in a retirement account. So I want you to automate the behavior as soon as you can. The investor who waits until they feel wealthy to use tax advantage accounts has already lost years of compounding. So other decisions you need to make intentionally between Roth and traditional contributions based on your current tax rate, expected future tax rates, employer matches, cash flow, and flexibility. So anything that we do here, tax arbitrage, it's none of this is about avoiding tax. It's really about being intentional about when and how the tax is paid. Real estate planning. Okay, so this is where a lot of we have a lot of investments in real estate partnerships, and cash flow is not taxable income. Because when I'm getting a distribution from an apartment building, that is not a taxable event. There was, if they sell the apartment building, that's a taxable event. If they do a refinance, depending on how the debt is, if they have to guarantee the debt, that may be a taxable event for me. So there's certain things that actually in real estate that trigger taxable events. But up until that point, any of the money that I get is not taxable to me. I was in an apartment building that refinanced 3 times, and I actually got my original investment back 3 times plus additional funds, and none of that was taxable to me because I was assigned what we call qualified non-recourse debt that gave me basis. And so that basis, until that basis went away when we sold it, nothing was taxable to me. When we're looking at real estate, we need to be thinking about, passive loss rules, depreciation, state filings, debt finance distributions. Okay, that can create complexity but as I said, it really depends on whether that can be a taxable event or not. Um, every investor should be tracking their basis annually. And, we've done webinars on how to track your basis. I can send you a spreadsheet on how to track your basis, but you really should be tracking your basis. I would never rely on the tax preparers to be actually tracking my basis because I know how much money I put in there. I know how much income got allocated to me from box two, maybe something in box, 10 or whatever. Um, but when I see something that's in other income or whatever, it makes me ask questions because why is that? Um, if the distributions, I know how much I got as a distribution. If I got $1,000 and it says 2,000 in there, I'm going to ask where my other $1,000 is. Or, I had one where it was a final K1 and the distributions were higher than what I'd actually received. So when I asked about it, they said, oh, well, there was money left in the bank account. So we just actually allocated it based on everybody's percentage of ownership. And I go, okay, since that reduced my basis, am I going to get the money? And if I'm not going to get the money, I want the K1 change to reflect my true basis. So in the end, since they weren't going to give us, now the thing is I don't know if they changed everybody's K1, but I do know that they changed my K1. Um, because if I'm not going to get the money, I don't want it showing up on my K1. So that's why each of us should be tracking our own basis when we're in a real estate syndication partnership. All right, so crypto, collectibles, there's all these other fun assets, but some of these fun assets, really need to be tracked. Crypto is generally treated as property. So it means like a sale, a swap, or even spending it can create a taxable event. Basis tracking for crypto is essential. And the IRS has been trying to get the brokerage houses to start, putting basis on crypto 1099s. They're not quite there yet. Collectibles, things like art, coins, wine, they all they have a higher maximum long-term capital gain rate. So when we're looking at these private use assets, we need to make sure that we've got the documentation, maybe insurance, storage, appraisals, charitable substance and sales records. All of those things matter if we're going to invest in crypto, collectibles, or any other type of fund asset. Really, the lesson here is that the tax character follows the asset, even when the asset is enjoyable to own, like wine. Um, Giving and family transfers. Okay. I'm always telling people that we should be thinking in assets, not in dollars. And in a previous webinar that we had done, we talked about, gifting so many of us are supporting our parents or helping our parents with their day-to-day finances. And we talked about gifting stock, appreciated stock to a family member. And if my family member is making less than 49,500, which if all they're living on is Social Security, they're certainly probably making less than that. Gifting them appreciated stock means that they can sell it and they're not probably going to pay any capital gains tax on it. They assume my basis in it. I've gotten rid of it, so I was going to have to give them, $20,000 anyway. So I look at a stock that's maybe appreciated, has a built-in gain, and I gift that to my family member. They cash it, they get the cash, and if they are in the 0% capital gains tax rate, they get to keep a lot more of, they get to keep it all. And I haven't used after-tax dollars to fund them. So there's lots of planning that can go into you know into giving and family transfers. As I said, appreciated stock securities is one of the more efficient, is usually more efficient than cash because the donor, I avoid selling it and I get to deduct the fair market value if I'm giving it to a charity. If I'm giving it to my family, I don't have any deductions. I just don't pay tax on the gain. Donor advised funds can separate the timing of the deduction from the timing of grants as well. So, as I said, I can put $200,000 into a donor advised fund, get a tax deduction this year for that, but I can actually decide where that money is going to, what charity it's going to go to over several years coming up. It's a good thing to do, like bunching can help when itemization is inconsistent as well. We also look at qualified charitable distributions. If you are a charitable person and your required minimum distributions are such that you can't use all that money, we would often say, you're giving to your church every week. Let's let's designate those as qualified charitable distributions. Have your brokerage house send it directly to the charity, and then we actually that will not be we get the charitable the charity knows that we have given them the money, but that money doesn't sit on my tax return, so it's not increasing my modified adjusted gross income. So it's not affecting maybe, what my Medicare premiums might be the following year because it's not going to be that income will not be sitting on my tax return. Uh, so this was the agenda. I was hoping that maybe you could, maybe take to your tax advisor, your wealth advisor, your attorney, um, you know, prior to year end, maybe, whenever you want to do it, but prior to year end, so you can talk about your income projection. What do you think your income's going to be this year? Do you have any embedded gains and losses? Should you be harvesting anything? Should you be giving, you know, charitable gifts away? Do you need to rebalance? What are your liquidity needs? We're looking at, threshold exposure. So depending on what your income is, are we getting near that net investment tax? Will my Medicare premiums go up if I'm at that age? What about AMT? What about, the SALT? Are my state income taxes going to be over the 40,000 so that I'm going to be limited again? What about a Roth conversion? We haven't really talked much about the qualified business income deduction, but there's also deduction phase outs that could change the marginal cost of my actual tax dollars. So, we got to be thinking about asset location. Should you be, are all the assets you're holding, are they in the right type of account? Um, when we talk about alternative asset risk, like, are you going to have K-1 delays that are going to make you have to estimate what your April 15th tax burden might be? Because the IRS doesn't, they give you until October 15th to file your tax return, so long as you file an timely extension. But any tax you owe is due on April 15th. So is your K-1 going to be delaying that? Was it a sale? If it was a sale, have you sold it at a loss? Because we're starting to see K-1s come in where people are actually, they've lost their investment. Even though you might have lost your investment, the K-1 doesn't always look the way you have been imagining it might look. It might actually have income on your final K-1, but you should have suspended losses that would actually offset that income. So that's all part of planning, and your tax planner should really be able to help you with that. Transfer planning, so we should be looking at estate, gift, charitable, insurance, all of these things we should be doing before year end. And as I said, if you're high net worth, you should already have a lot of this already embedded. If you're a new investor, these are all of the habits you need to be forming now so that when you do have a complex balance sheet, everything is going to be tax efficient. So two investor profiles, basically at the end of the day, we said it was, high net worth investors, they have complex balance sheets. Early investors are actually creating the habits that will serve them long term. Um, Often for a high net worth investor, your action plan is a 3-year projection, a liquidity map. We're looking at estate exemptions now, a review, because a new Congress could change these things. Roth conversion testing, charitable bunching, tax package, diligence before committing to private deals. If you're just starting, and building wealth, your action plan's a little bit more basic, but it's still very powerful because you're going to automate your tax advantage savings. You want to use low turnover investments in your taxable accounts. Track basis and holding periods. Avoid unnecessary short-term trading because short-term trading is ordinary tax rates. If you've held something for 11 months, you might as well hold it for another 31 days to get it over the 1 year mark to make it long-term. And make sure that you have beneficiary designations and that they are up to date. Sometimes you don't, I mean, you can sign up for an IRA or 401k at work and you don't even have to put a beneficiary in there in the beginning. If you don't and something happens to you, you pass away, that IRA will go to your estate. And the tax consequences of that could be dramatic. So, not everybody needs the same investment strategy, but everybody needs to be planning. And the earlier you start planning, the better it is. Taxes shouldn't be a year-end cleanup. They shouldn't be a once-a-year thing. And it shouldn't be a burden. It shouldn't be, oh, I got to file my taxes again. If you have been thinking about it and planning about it for the whole year to minimize your tax burden, it should be like exciting. They just shouldn't be something that you do once a year. And, we never used to send out the tax planners until January, but that's already too late. I mean, I would be contacting my people that had S Corps so we could look at their wages. We needed to give taxable bonuses because we wanted to make sure we got it in their W-2. We would be looking at, partnerships, like, we looked at everything. We looked at, where should they be harvesting tax losses. I worked actually with their attorneys, their wealth advisors. We were a team, and you all need to find a team. Um, so. This is just some, sources where this all basically comes from the tax code. I mean, there's nothing in here that's outside the tax code. This just gives you some of the specific IRS, sections of the code if you really want to look it up. And this is just some information for me. Like I love tax. I love to answer tax questions. If you have any tax questions that you'd like to ask, my email is there. And we'll open it up for questions for this last, I think, 10 minutes or so here. So, Chris.
Yeah, absolutely. Thank you for that presentation, Deborah. A lot of value there. And if anyone does have questions, just type it in the Q&A box, and I will, read them to Deborah. The first question: what should you expect to see on a syndication K1 that paused distributions? What should we watch out for on the K1?
If they pause distributions, there shouldn't be. Now it depends on what time of the year they paused them. So if they paused it, midway through a year, you're going to have a number in box 19. If they pause them for the entire year, box 19 shouldn't have any numbers in it. But things to look out for, like when they pause distributions, sometimes that makes me happy because I want them to keep the money to actually operate the property. So often, one of the questions you should always be asking is, are these distributions coming from cash flow, or am I just getting my investment back? There's a big difference there, and we always want it to be coming from cash flow. And I'm always happy when they pause distributions to keep any cash flow so that they can operate the property because we are still in uncertain times. And I mean, in the last 3 months, I think, they were talking about I don't know if the 5-year or the 10-year treasury's gone from 3.5 to 4.3 again. I mean, we are just the world economics, the war in Iran, all of these things are still affecting our partnership syndications. But you should
Thank
be
you.
tracking, but you should be tracking your basis because what you definitely don't want is something in box 19. It says you got $1,000 when you know you only got 200. You need to be questioning that, but yeah.
Thank you for that, Deborah. And okay, we have some more, another question. The question is, I was investing in a multifamily syndication deal that lost the entire capital. Can I get tax deduction on the loss? Both my husband and I are W-2 earners, and will I get the loss offset to my active income? What if I am a real estate professional?
Okay, if you're a real estate professional, I would assume that you've already been taking losses from those K1s already. So I'm assuming then if you're a real estate professional, you don't have what I would call any suspended losses. Um, I've also just lost my investment in a, partnership K1, and I treated it as active, I mean, as passive. I did not move it into the active bucket because I already had passive losses, you know, I already had suspended passive losses before I became a real estate professional. So when I was making the choices of which K1s I was going to pull into my active real estate bucket, I did not pull this one in. And so my suspended losses will, I should have, like, I've lost my entire investment as well. I should be able to deduct that because if a final K1 releases all suspended losses. So all of my losses for that particular K1 will be released and it will offset my ordinary income. It only happens on a final K1 where any passive losses that have been suspended will actually offset ordinary income.
Thank you for that, Deborah. A lot of information there. Does anyone else have any additional questions? Uh, I,
If anybody wants the PowerPoint, if they email us, we'll send the PowerPoint to you as well. There was a lot of information in there that I didn't read or whatever, so it might be beneficial. If nothing else, just even the agenda, so you can take that agenda to your tax preparer or maybe your attorney or wealth advisor. We'd be happy to send it to you.
yeah, absolutely. So you can email Deborah at disruptequity.com or team at disruptequity.com, and we'd be happy, to get that over to you. And well, we have one more question. Okay. In the loss scenario, what if there wasn't a K1 and it was a 1099 instead?
Well, a 1099 to me means that, I've invested in a C corp. And if I'm going to lose my equity, like there's places on the 1099 that will show what your basis is, because one of the C Corps I'm in, they actually gave us back our initial investment. So I've been tracking my basis on that K1, and I can't remember what the box, I mean, on the 1099, and I don't remember the box number. It actually said what my return of my investment was on there. Now, if it's a complete loss and they say return of investment zero, then I would assume you'd be able to take that loss. But there should be something on that 1099 that references that loss.
Thank you for that. And does anyone else have any questions for Deborah? Well, no, I want to thank you for the presentation. There's a lot of value there, a lot of great information that, yeah, I hope all the attendees got value out of. I know I did.
Mhm.
And, watch out for our next. Oh, we do have one more question. Okay. Uh, it was an income fund that did not work out well. No 1099 for last year and no communication from the operator. Is the loss spread out over several years, or can you all be taken at once?
And honestly, like I'm not going to say it's a loaded question. It's something that I would be evaluating with my client. We would be talking about it, especially since you said there's no communication. Because if you've gotten 1099s previously, I'd go back to the last 1099 I got, see if there's anything in that box about basis information. Um, it is something that you should be talking to your tax planner with. Because maybe it's something you can take as a loss if it's, if it's completely, an income fund that has gone under. Because there's all kinds of documentation, and there might be documentation on the internet that you can get that says, yeah, this has gone under, because somebody usually has to pay to prepare 1099s. And if nobody has any money to prepare them, it's possible you aren't going to get it. And so, but it's all stuff, and I can say that I had clients where we would document everything in case the IRS came back and said, where's proof that you've lost your entire investment. So it is something that it's possible, but you'd have to talk to your tax preparer to get a plan together for it.
Okay, and I believe you addressed this on the previous question, but one last
Uh-huh.
question for Rich. Can you spread large losses to other years?
No, I mean, when you get a final K1, it is going to actually release all of those suspended losses. Now, it's possible you could have it might create an NOL, but I mean, basically at the end of the day, if I put $100,000 into something, all I can deduct is $100,000. So I don't have losses, um, if I don't have enough income to offset that, it would create an NOL,
Okay.
which would actually go to the following year.
Okay. Thank you for that, Deborah. And no, I wanted to thank everyone for joining. Yeah, next month on the third Tuesday, we will be having another Investor Power Hour related to how to build generational wealth for your children. So, very excited about that one, and looking forward to seeing everyone next month.
Mhm. All right. Thanks, Chris.
All right. Thank you.